Welcome back to Money Life, where the subject now is going to be one of your favorites, because I know you love it when we talk about dividend investing and different ways to do it and what's happening in the dividend investment picture. And my guest right now is Barry Martin. He is manager of the Shelton Equity Income Fund. It's ticker symbol EQTIX. If you want to learn more, sheltoncap.com is the website. But I'll point out that this is an interesting fund, got a really good track record, but a really interesting dividend and payout history, as well as methodology for doing it. So we're going to jump in. Barry Martin, thanks so much for joining me on Money Life.
Thanks, Chuck. Thanks for having us on. Appreciate it.
Barry joins me on the Gainbridge hotline. Gainbridge provides direct access to trusted financial products that are guaranteed to grow your money over time without worrying about fees. Starting with $1,000, let the self-managed online platform give you the access and control to manage your money your way. Gain access, gain control, Gainbridge. Barry, let's start with the outlook for dividend-paying stocks in an environment where interest rates are going up and we're starting to see changes, because for a while now, dividend-paying stocks have been everybody's answer to, hey, I can't get much when it comes to interest rates. So how does the general picture change when we get into a rising rate environment? Or is it going to take a while? Like the Fed's telegraphed 3 rate hikes, but we're going to have to see 5, 6 before the environment truly changes.
Yeah, Chuck. So at Shelton Cap, we do things a little bit different. Not only do we own the dividend paying stocks, but we also sell covered calls on them as well. So in a rising interest rate environment, covered calls actually do very well, because as interest rates go up, we actually receive more for selling the calls. So I don't know if you've noticed, but our 12-month trailing yield right now is over 9%, according to Morningstar. And that includes the dividend of an ongoing stock, the calls, the income received for selling the covered calls, and also any short-term gains that are associated with the appreciation of the stock. So not only do we have dividend payers, but we're juicing that by selling covered calls.
For investors who don't understand, explain how covered calls work and why you want to have them as part of the strategy.
Yeah. So for example, Apple's our largest holding. What we do is we own Apple, which is priced around around $170 per share. What we do is we sell someone the right, but not the obligation, to purchase Apple off of us in the future. So someone's willing to pay us $1 to buy Apple off of us in January at a $187 price. So basically, we're selling someone the right to purchase Apple off of us at $187 when it's $170 right now in 31 days, and they're going to pay us for that right. Now, if Apple never goes to $187, we take that dollar, put it in our pocket, and then pay it out to the client in a quarterly dividend. Now, if it does reach $187, then we have a decision. We can sell our stock at $187, which is basically 10% higher than it is today, or we can buy the option back and sell another option. But you can see, and during that time, we also take in the dividend that Apple is paying. So we have 2 sources of income here that we're generating. One is for just owning the dividend, owning the stock and getting the dividend, and also receiving the money that we're receiving for selling the covered call.
In terms of the complexity of the strategy, I will periodically get individual investors going, well, what do you think of a covered call strategy? And my typical answer has been, I like a covered call strategy, unless you tell me that you're going to be the one to do it. And by you, I mean the individual investors going, hey, I heard about this. Do I want to go do this? Obviously, money managers have a big edge here, but there would be those who would say, wait, aren't there dangers? Aren't I adding some complexity when I add optionality to a portfolio? And if it's bad or difficult for the individual, why is it so much easier for the pro?
Yeah, so that's a good call. So with us, when you sell a covered call in position, you're actually reducing the risk, first of all. So our standard deviation is slightly over 14. So if you're looking at a Morningstar risk-adjusted return metrics, we look pretty good. I mean, right now we're 4 stars on Morningstar. In fact, we're at a 5-star rating in the last 5 years. And that included, obviously COVID situation last year. So when you sell a covered call, you're actually reducing the risk profile of your portfolio. So in that case, it's actually less risky than owning stocks outright, just like the standard deviation. But you're right. It does take some work. It does take some discipline. And that's where we step in. We're professionals. I've been doing this for over 20 years now. And it just makes more sense for us to do it because it is time consuming, even for the professional advisor. I mean, it makes sense for a lot of people's portfolios because you get similar market returns with lower standard deviation. So it makes sense, but it's hard to do. And that's where we step in. And that's all I do, every day is basically option overlay strategies for clients.
What winds up happening? You talked about how covered calls work better in a rising rate environment, but what's going to wind up happening? What's your outlook for dividend payers in general in a rising rate environment? Because dividend payers have definitely been helped by how much demand is there. It's been pretty much inexhaustible demand. Now, if you get rates up enough, you will have some folks who maybe say, hey, maybe I can get some of that elsewhere, and maybe dividend payers are not quite as attractive in this environment. So what changes in generally about the demand picture for dividend paying stocks overall in this kind of condition?
Yeah, no, I still think it makes a lot of sense just because, you're looking at alternatives, with rising interest rate environment, that affects growth more than would be dividend payers. And so from our point of view, you'd rather own these large quality names that pay a dividend. And especially for us. I mean, we don't see huge appreciation in these names. That's why we do think covered calls makes a lot of sense in this environment. Because with covered call writing, you do have asymmetric returns where you're capping the upside at a certain level, but you have a lot of the downside risk. So what we do is and it's just how covered option writing works, is that we buy quality names that generate sizable free cash flow, and in turn, those names actually do pay dividends. So we're not specifically looking at dividends per se. It's just that the companies that we buy end up paying a nice dividend. And so with covered option writing, if you want to use an analogy, if the speed limit's 55, I'm driving 45 miles an hour, avoiding potholes, right? I'm not trying to hit home runs. I'm not trying to find the high growth names. And those are the names that I believe really do get hurt on a rising interest rate environment. If you're looking at alternatives to equities, you could be looking at fixed income, but that's another place that you have to be nervous about with a rising interest rate environment. So right now, I really truly believe dividend paying stocks, and for us, paying selling the covered call on top of that just makes a lot of sense.
Let's also try to help people figure out how this kind of strategy fits in, because so many folks have been turning to dividend paying stocks and dividend strategies as an alternative to fixed income. But that is a step up the risk scale, and that's a step up the risk scale before you add in any optionality and covered calls. So if somebody is going to use a fund like yours as an income provider, where does it fit in the portfolio on the risk spectrum as quasi fixed income or fixed income like, or whatever you want to call it?
Right. Yeah, great question. How we like to call it is basically the halfway house. We're in between fixed income and equity. So if we're going to talk to a client and say, hey, take some of your fixed income exposure and take some of your equity exposure and create a new part of this pie. So if it's a 60-40 portfolio, now you go basically, 50, 30, 20, and 20 being the covered option writing, we believe. Because it's that risk return dynamics are basically in between. So our standard deviation, similar to the long end of basically similar to a 30-year fixed income vehicle, but you do still have some equity exposure. So it's basically that right in between. And just on a basic risk return metrics, if you add this to one's portfolio, you're actually reducing one's risk overall because it has a different return pattern. This tends to do very well in choppy sideways markets, but underperforms in drastically up markets. So what are we going to see going forward? Volatility is in the low 20s, high teens, but we still have obviously growth. Inflation, maybe it peaked recently and we're going to see it going down, but it's still going to be elevated. So I think right now we're in a good space for equities, but also since, we have the elevated volatility, we're selling that vol. And what that does is that cushions a lot of the downside risk of one's portfolio. So just adding it to a fixed income and equity exposure or equity portfolio makes a lot of sense.
We are looking at a stock market that has done, I think, better than most people could have forecast. I mean, a year ago, nobody was expecting the kind of year that we've had in 2021. So what are you expecting generally out of the stock market for 2022? I mean, we're back towards record highs and there's a lot of nervousness, but the market has traditionally climbed a wall of worry. Do we keep climbing or do we take a breather?
No, I think we still are in the same spot. I don't see any huge downside risk on the horizon. Obviously, COVID can peek its ugly head up every now and then, but in general, companies look good. There's still a lot of demand out there. So I think at least for the first 6 months of next year, it should be looking pretty solid. But in saying that, I still believe volatility is going to be elevated. Right now we have volatility in the VIX is in the low 20s. I can see that being, spiked to the high 20s, low 30s. And when that happens, you just have to take advantage of that. And what we do is we sell that vol by selling the covered calls.
Very great stuff. Thank you so much for joining me on the show to talk about it. Happy New Year.
Happy New Year. Take care.
That's Barry Martin. He's manager of the Shelton Equity Income Fund. It's EQTIX. SheltonCap.com for more on the firm. SheltonFunds.com to learn more about their funds. We just hit the halfway pole on the Monday, December 27th edition of Money Life. But halfway? Come on, we're just building speed. So settle back, relax. Second half starts right after this message.